Joining me today on Brief Encounters is Mark Austin, a leading figure in financial markets regulation and corporate governance. Mark was recently awarded a CBE for his work in reforming London's listing framework, and we're super happy to have him today on the podcast. Welcome, Mark.
Thank you very much, Richard. Pleasure to be here.
We met each other, I think, over a decade ago when I was kind of carrying your bags at Freshfields, and we worked on a couple of transactions together. But tell us, how did you get into this specialism, and how is it that you sort of landed so firmly in the world of capital markets?
Really, like so many things in life, Richard, it was happenstance, to be honest with you. Like you, as you say, we worked together at Freshfields many moons ago. And it was actually just because I always knew I wanted to be a corporate lawyer. I sort of fell into law, and I always knew I wanted to be a corporate lawyer because I just thought that's where the centre of things were. It was the centre, if you remember, I sort of thought it was the centre of the heart of client relationships. You were at the heart of every deal. I wanted to be a transactional lawyer rather than a litigator. Um, for example, and then actually it was simply because ECM and capital markets was simply because my first seat as a trainee was with a capital markets senior associate who was in the run up to partner, and so my first transaction was an IPO. In fact, it was the Xstrata IPO. Where I ended up doing verification on that deal and a lot of due diligence, and it sort of just went from there.
Awesome. And I think, since we were working on those deals, which is, I think, over 10 years ago, now kind of a lot has changed in equity markets in general. But before we get into the kind of the listing rules piece, what have been the most significant shifts that you've seen in listings generally?
I mean, certainly in more recent years, we have seen public market activity die down. I mean, it's been a factor of a function of higher interest rates, inflation. It's been a capital cycle that we've seen before, where actually the public markets and the number of companies accessing them, new companies accessing them, has become quite subdued globally. And actually, that's true even today, to some extent. I mean, it hasn't fully revived even now. I think what's also happened is that the global war for where companies should list has become more pronounced. There's a real arms race amongst different countries now in terms of making their financial centre the most attractive listing venue, particularly local companies, but also international companies worldwide. And you're seeing this reform agenda that we'll talk about a bit more in a bit being taken up all around the world. I mean, the UK was, by many measures, the first to sort of jump on that, to recognise that, and that was something that was instigated by the referendum. What that then caused in terms of the rethink, but you're now seeing it in jurisdictions all around the world. So, most recently, Singapore came out last week with a whole package of market reforms, both fiscal, listing regime reform, demand and supply led reforms. I mean, it's pretty impressive, to be honest with you, including a 5 billion fund to actually make those investments as well. But you're seeing it in the Middle East, you're seeing it across the EU with the EU Listing Act and other reforms. Obviously, the journey's been going on now in the UK for 4.5, 5 years. And even in the States, although the States is a little bit of a case on its own, to be honest with you, it doesn't really need to, for reasons that we can talk about. But that's the main difference. Is just that everything's become so much more competitive. It used to be, it's not just anymore, it's just New York or London. It's, there are many, many global exchanges around the world. And also capital has become more global. And global investors, if you talk to them, are relatively exchange agnostic, is the dirty little secret. I mean, they're looking for good companies, and they don't really mind where they're listed to a large extent.
It's definitely been our experience. I mean, we were obviously earlier in that capital raising journey, but I think two things that struck us was one, actually, how the availability of venture capital, growth stage venture capital, had certainly shifted, and we were able to raise from US venture capital firms without much trouble, without relocating into the US. And the second was actually the bar for an IPO in our space of broadly software as a service has risen as well. And there was a time you'd say, well, we're at 100 million in revenue, let's go and list on the NASDAQ. And now it's sort of, entry level 3, 4, 500 million. And you see this sort of, real scarcity of listings that is actually happening. But it's
Yeah.
been super, super fascinating to kind of follow the journey here. In context of,
But it's important that because I mean there is a point here. People think that sometimes this isn't important, but and they say, well, maybe private markets are the future. I beg to differ with that pretty strongly because private markets, yes, they're here to stay and they've enlarged massively and they continue, but they're always going to need public markets. They're always going to need public markets to exit those investments. The VC players we talked about and the private equity players to exit those investments onto. And you're seeing that right now. Actually, Bain came out. I saw and read in the paper this morning the amount of money going into private equity fell for the first time. So there is there is an end of the funnel point there for investors that they need public markets to function effectively, and also just being a bit social about it. Public markets, when they work well, are actually a social good, I believe. I mean, they are the greatest democratization engine you can have for wealth, really. My mother in Yorkshire, being able to invest in the stock market in a fluid and non-overly risky way, is a very, very important societal good in terms of societal wealth distribution.
On that subject, which I think is a super interesting point, you were obviously advising on these listings for a long time, and then you've now got involved, very heavily with the UK in kind of driving change here. But tell us about what was the genesis of that? How did you go from sort of being an advisor in private practice to actually like really leading this, national change of how we view listings?
Well, it all started with a certain referendum, and I won't use the B word, and I won't express any view on the B word. But there was a referendum in the UK in 2016, which resulted in Great Britain leaving the EU, and that wasn't. That was sort of the catalyst for us. Overnight, UK became, instead of becoming the default listing venue for companies for whom New York was not the right answer, it lost that position, at least in perception terms. And so it became an exercise really in saying, we don't have that luxury anymore, and we need to look to ourselves and try to take out the friction points that have built up in the UK capital market system frankly, in the last 20, 25 years. I mean, we'd always known they were there. We'd always known what they were. But because people came and used the London markets anyway, much as they still do with New York now, we thought, well, we'll do that tomorrow. Looks a bit hard. We'll do that tomorrow. But then the referendum result took that luxury away from us. Lord Hill got appointed to a listings review in 2020, end of 2020. And the way I got into it was because he rang me up, and Jonathan's a superman, but he is a politician. He's not a capital markets expert. And he said, I've heard about you. Can you help me? And obviously I said, yes, of course, I'm very happy to help. And so I advised on his review. Then one of the recommendations that we put in his review was to look at the whole secondary capital raising regime once you're listed. And then I got asked to do my own review into that, and it sort of just carried on from there, really.
And it's such an interesting thing, actually, having someone who's actually experiencing those friction points, actually advising as you're building a prospectus, you actually are feeling that pain as opposed to it being kind of theoretical. I mean, across these various reviews, what have been the most significant changes to the listing rules that have come out?
So there's been a welter of them, haven't there, now since Jonathan's first review came out in March 2021. I mean, in pure listing regime terms, I think the most significant are probably, and the quickest that happened, where we took the free float in the UK, so the shares have to be in public hands down from 25% down to 10, which is bringing it in line with the US and a few other markets around the world. We've also adopted a much more liberal attitude to dual class share structures. They basically weren't permitted prior to this reform journey starting, whereas now you can list in London on the main listing segment and have a dual class share structure. And still actually get in the FTSE as well, so you can still get in the FTSE 100 and FTSE 250. So that's been a big change. There were two fairly misunderstood main listing segments. We've collapsed that down to one simple listing segment. We've made the eligibility requirements to list more relaxed. Once you're listed, it's now also much more frictionless in the UK, because it used to be that you had to go, if you wanted to do a significant acquisition or disposal, you had to go and get shareholder approval. You don't have to anymore. And you don't have to get that either around related party transactions. The key thing there is that really what's happened is that the UK listing regime has moved back to where it was 20, 25 years ago, which is much more like in the States and in various other jurisdictions of being a caveat emptor approach. It's disclosure based. It's based, and that really came about. And the reason the FCA really got religion on that was when they actually talked to global investors, but the people who actually ran the money, not the governance people, the people who actually ran the money. So the CIOs and the PMs. And I remember a call I set up for them where they came on the call and said, look, we don't care about shareholder votes really. We don't care about having conditions around your class share structures. All we care about is that we get full disclosure, and we're big boys and girls, and then we'll make up our own mind about whether we want to invest or not. And if we don't, our ultimate sanction is we walk away. Or if we quite like the company, then we'll talk to management and we'll refine it. And if they're open to that, then maybe we'll invest. But we don't need a regulator looking over our shoulder. And so that's really in at 30,000 feet terms, that's really the key change that's happened in the UK. And it was never really in the UK about It wasn't ever about trying to create Singapore on Thames. It wasn't a, oh, right, we're out of the EU, let's do a race to the bottom, deregulatory race to the bottom, Singapore on Thames. It wasn't about that. It was only ever about taking the friction points out of the system and creating a level playing field with other jurisdictions. And I think now we have successfully done that. And it's not, I should say, Richard, it's not just reforms on the listing regime side. There's a whole wealth of other stuff that we've been doing in the UK as well around corporate governance, much more relaxed approach to that now. Remuneration, again, conversations really changing on that now, moving much more to a sort of US style approach to remuneration. There's further to go on that for sure. Also, then on capital, there's a lot of work going on capital, driving more capital flows back into the UK, which no is desperately needed for sure. But people do also need to remember that UK is still the most, London is still the biggest and most liquid capital market in Europe. So.
And it's become so topical right now. And if you look at the sort of post-budget narrative around how do you find growth, I mean, all of those things that you're mentioning are potential drivers of growth in the economy. Just thinking about the tech example, I mean, if you look at the kind of figures in more early stage around Europe and where kind of tech is playing, I mean, London and the UK is still, quite competitive within the context of Europe, and you're starting to get that first generation of really big companies. So we just had the general counsel of Revolut on this podcast. Revolut's kind of classic example with a kind of international kind of choice of capital. Like how far along do you think we are in the reforms we've made to be able to go and actually attract sort of $50 billion giant tech company to actually list in London and not choose New York NASDAQ kind of obvious examples?
My take on this, and I'm an eternal optimist, and I've been living this obviously for 4.5, 5 years, is that we are almost there. Now you wouldn't always believe. Now you may say, well, you would say that, wouldn't you? But and you wouldn't always believe it, as I think you were just alluding to from the public narrative. But this is my key point here, which there is so much that has changed in the last 4.5, 5 years in the UK. The listing regime is now at least a level playing field with other jurisdictions, including the US, by the way. It's actually more friction free than the US if you actually dig under the surface. The US is not an easy place to be listed. And I looked after Zoopla when they listed in London, and then Alex's next business, Kazoo, when it listed in New York. And if you talk to some of the people who did both of those, you'll get a pretty surprising answer around the comparison between on the ground between the two jurisdictions. But if you look at what London's done, the listing regime is now more or less a level playing field, and in many cases actually more liberal than other jurisdictions, particularly the US, but also continental Europe. The governance regime is now much more flexible as well. It's properly gone back to a sort of comply or explain. You don't have to comply. And actually, if you look at, I was looking at this yesterday, if you look at companies that have listed in London in the last few years, over half of them haven't complied with the code. They've explained why they haven't, but they haven't complied. So it is not a rule, and it gets misinterpreted as such. And then on the capital side, there is the issue of outflows, but there is still a huge amount of capital to be deployed in London, and we forget, I think, sometimes, or the public narrative forgets that it is still the biggest and most liquid capital market in Europe, particularly for follow-ons. I think that also gets missed sometimes. This is a particular point for shareholders, obviously, but there are some like Revolut, some very, very big companies in this coming cycle, which is about to hit out of private capital onto the public markets again, that are not where their current holders are not going to be able to exit them at the point of IPO fully. Then they're going to have to hold on and still be invested for another 2, 3, 4 years, whether they're VC or private equity houses, and they're going to need to do several pretty chunky follow-ons. And you need a market that's got a big functioning follow-on market, and London does have that. Much more so than any other European market, to be honest with you.
I mean, it's so interesting to hear that as well, because I agree that I don't think it's fully in the public narrative, and there is a kind of wave of negativity generally about the UK economy that can sort of swamp that point. But I mean that's actually very significant, right? When it comes to a tech company actually choosing to list is more burdensome in the US. I think that.
But it is. I mean, it is, and I mean, this is one of the things I bang on about a lot at the moment. Is actually just telling people in the UK to stop being so British. I mean, but we do. I mean, obviously I'm a Brit, but we do sort of have a tendency to wake up in the morning, oh, it's raining again, and be very Eeyorish about everything. And the media obviously can sometimes weigh into that as well, inform that narrative. But actually, and I see this in my day job, day to day, and I'm doing it with a number of issuers right now, very big issuers, who are doing a side-by-side analysis of London, Amsterdam, New York. And actually, when you actually get them to focus on the actual facts on the ground, they go, oh, I didn't realise the UK was like that. Because all they read is the headlines in, I won't name any media outlets, but in X or Y newspaper or magazine, and just to have this assumption. And it's not, there is a there is a general need at the moment to channel our inner American in the UK a bit more. And I think people forget that positive narrative creates positive perception, creates positive reality. And now we're in a happy position where in the UK it's based on facts. It's based on all the stuff we've done in the last 4.5, 5 years. And if you increasingly talk to bankers who, when we do these side by side comparisons, and actually the capital markets answer to the question of where to list often pops up as London. So it's often the softer points around where will I get beaten up in the press? Will I get more noise if I have a non-independent board? Will my REM be on on the front of the Daily Mail? It's those sort of questions which still need to be addressed, which are harder though, which crop up as friction points. Being honest.
And those other friction points, I mean, the things we hear from time to time, taxation, stamp duty, for example, I think came up in the context of the Revolut CEO. I mean, are there sort of what are the other areas that maybe go beyond kind of regulation that actually can significantly sway where people want to list?
I think it is those points. I mean, it's that general public perception about the UK not being open for business that we're having to fight, actually. There's a general sort of negative perception about the UK, which wasn't helped by the budget, which you just mentioned. But actually, if you look beneath that, the UK has considerable tailwinds at its back. To my mind, they fall into three buckets. The first is this whole reform agenda that we've just been talking about, which is now nearing completion, and that comes through certainly the listing side in the start of next year when the new prospectus regime, refined reform prospectus regime comes through. So you've got that, which has created a level playing field with other jurisdictions around the world, and in some ways a more liberal one. The second one is this coming, which I mentioned earlier, this coming cycle out of private capital into public capital. And this goes back to the point we were talking about earlier, that private markets, however big they ever are always going to need public markets. And that's coming. We all know that. Interest rates are coming down, inflation's come down. It's just a question of when that starts to go and when the first companies dip their toe in the water, both in the States and in Europe. My view on that is that that's likely to be Q4 this year, but certainly into 26 and 27. I mean, there's a lot of conversations going on now about listing in 26 and 27 with potential issuers and their shareholders. But the third one's quite interesting as well, which is, and actually in some ways the most important one, I call this sort of the geopolitical angle or geopolitical tailwind, which is that ever since President Macron called those snap elections in France last year, we've had a lot of inbounds around people, looking at France and thinking, well, you've got the prospect potentially of a Le Pen presidency in France in a couple of years' time. You've got obviously the German elections, although Merz overnight is found to be seemingly pretty reformist on the fiscal side at least. You've got Meloni in Italy, you've got Wilders in Netherlands. The EU, and obviously everything's been snow globe's been slightly thrown up in the air since the 20th of January, for obvious reasons. But the EU is not as stable a place as perhaps it was 5 or 6 years ago. And actually, it has its own issues, and obviously it's always had the north-south budget and fiscal issues. You've got Asia, where last summer one of the deals that we did was helping CK Infrastructure, who'd been listed in Hong Kong for 30 years, to get a secondary listing in London as soon as the new regime came in for secondary listings. They're a global company who didn't want sole exposure to Hong Kong anymore. And that's an interesting theme that's starting to come through. Although now, as I say, you're seeing some of the Asian stock markets respond in kind with their own reforms. But there's a theme out of Asia, and none of those companies, by the way, are going to go to the US for obvious political reasons. So they're all looking at Europe, and they're tending to look at London. And then there's the US. I mean, there was a narrative, and you'll probably be very conscious of this, Richard. There was a narrative maybe 2 years ago that was sort of prevalent around, well, maybe actually New York and the US are the only capital market you need on a global basis. It could be the world's capital market. That on the ground has disappeared now as a narrative too. New York will be the right answer for many companies, but it won't be for all companies. I tend to say that if you're a sub 10 billion market cap foreign private issuer, i.e. not a domestic US business, you've got a very high chance of you listing in the States of becoming an orphan on that market and getting lost. And we've done quite a lot of empirical work on this. There was a report I did last year with Nigel Wilson, which looked at the share price performance of 20 UK companies that are listed in the States. All but 3 of them are underwater now, and quite significantly. And actually, valuations are no better than they would have been in Europe, I'm pretty sure. The New York is, well, for certain sectors, and tech is one of them. Clearly, there are very reasons you would go there, given the analysts, the depth of capital, et cetera, et cetera. Your comps are there. But actually, it's not the right answer for everybody. And so there is a narrative for the UK right now, which I've been talking to a lot of people about recently, that where it sets itself up as an independent, stable, now reformed and friction-free, flexible, well-regulated, independent financial centre that's not the Asia, that's not the EU, and that's not the US. And that's a pretty compelling narrative. And but it does require us all to be a bit less British, as I said, and actually putting it forward.
I definitely agree with what you say around, ultimately it's a rational choice. So, whether or not it's been kind of traditional for UK tech companies that have gone on to do well to list, at the end of the day, we'll look at the side by side probably, and we will figure out what makes the most sense for the business. And the other thing is interesting is, especially in software, is just how international it has become. I mean, for us who founded in the UK, it was kind of, well, you have to open in the US to get any traction. We had 40% of our revenue coming from the US before we had boots on the ground. So you kind of have this inherently international business, in which case it's also an inherently international choice of where you want to raise capital and how you want to do it. So I do definitely think things are changing. We've got a lot of listeners who are general counsels and in-house lawyers who are in kind of pre-IPO companies. And so as they kind of go to this more sort of golden period of 26, 27, what are the kind of key variables in this side by side? Like what are the parameters of choice that they should be thinking about when it comes to where to list?
I do think when you're thinking about it, you've got the sort of empirical point around doing a side-by-side objective analysis of what the rules in each listing venue say. And you will find that actually, if you do that New York versus London, and obviously you may have some European listing venues like Amsterdam or Paris or Frankfurt in there too, depending on the business and where it's founded and located. But it's certainly if you compare, just for simplicity's sake, New York and London, um, it's pretty onerous in New York. I mean, you've got to have a independent audit, what's called a PCAOB audit, done on your financials, and that has to be completed before you can even file with the SEC. And it has to be done by an independent auditor. It's expensive and it takes a lot of time. You don't have to do that in the UK or in the EU generally. The SEC is a very thorough, shall we say, and pretty invasive regulator in a way that the European regulators are not. So it's a less intrusive process from that point of view. The other thing I would say is that once you're listed in the States, you've got quite a lot more obligations you have to comply with. Sarbanes-Oxley is obviously the primary one, but you've also got things like shared litigation culture to contend with, which is just a fact of life over there. It's almost a sunk cost, whereas you don't have that culture over in Europe. In the actual IPO process itself, the approach to research and publicity is quite different. So you don't actually have research during a deal in the US IPO, whereas there's a pretty involved connected analyst research production process in Europe. And also the publicity parameters are much more flexible than they are in the gun jumping rules, etc., in the States. So actually, that's point one, is to look at those on the ground empirical sort of granular points around what the process will be like. Then I think the next thing, if I was a GC, I'd be thinking about, well, given my specific sector, and assuming most people listening to this are tech GC, but actually my specific vertical, where are the comps listed, actually? And you probably will find that a lot of them, if it's tech, will be listed in New York. But the key thing is to actually look at how they performed. Look at how they've performed, and what's the share price done since IPO, and how easy do they find it to attract new capital and to turn over their shareholder register to the extent they want to, because that's where one of the myths I think abounds. And there's an example like Wise in London. It's been a very successful float in London. There have been others that haven't been quite so successful for different reasons. But there is some. I think there is people overlook sometimes the scarcity. The benefit of being a bigger fish in a smaller pond, rather than being a very very small fish in a very big pond and getting lost. So I think those are the two key things I would think about. I'd also just think about the internal culture of the business and how, because I imagine a lot of your audience will be people where you would say that the secret sauce that has made the company the success it is today is the culture. And how do you, one of the things we always talk to, one of the first items to people when they think of going public is, we need to think about how we can cleverly and artfully preserve the culture of a private company as far as we can in a public company context. And that often gets overlooked. And that can be down to lots of little things. It can be, for example, one example is when you go public, You'll have, if you list in the States, the concept of MNPI, material non-public information. If you list in London, for example, inside information or price-sensitive information, lots of tech companies I work with flash that information around the business every single day for obvious reasons. Funding Circle was a good example. When they listed, they flashed their loan origination daily data around the whole business. That's their key KPI. You can't do that once you go public. So you need to have a think about how you're going to square that circle, but still keep the culture the same. And ultimately, there we ended up doing it by jurisdiction, because by jurisdiction it wasn't actually material to the group. But it's things like that that you need to start thinking about early on, and actually comparing the regimes between jurisdictions as to how easy it might be for you to preserve that culture. Because this is one of my themes actually that we're sort of trending into on the reform debate now, is that the delta between public and private markets globally, it's not a jurisdictional point, has become too big. I mean, and it needs to get narrowed given the symbiotic nature of the two markets, because whether you look at investment horizons, director liability, remuneration, there's any number of buckets. The delta's become too big, and I think governments and regulators are now starting to realise that they have thrown too much mud at the public market wall, and they just see that, like, oh, you're a public company, right? Here's some more regulation. You'll be able to bear it. And for the biggest companies, that's fine. But for the average company, mid-sized or smaller company, they don't have the teams to do that, and it's not all it acts as is a disincentive to go public. And so it's it's a really interesting area of discussion right now, actually.
Thinking also about those who are actually very close now to IPOing. I remember when we worked on a couple of these transactions. Actually, in one, I was seconded. You seconded me to a client, and I was there for I can't remember how many months, but working with the client on getting ready. The pre-IPO preparation. What should GCs be thinking about in terms of getting the business internally ready to go through one of these transactions?
Well, the first point to make there is that you can't start too early. I mean, I actually talked at a dinner a few months ago about if I was a GC of a pre-IPO company and was 2 years out from IPO, what would I be focusing on? And actually, the number one point I made was the point I just talked about, culture. I'd be thinking about, I know how this business operates. I know why this business is a success. How am I need to talk to some advisors to work out how we can best preserve that. And if we need to morph, do it gradually rather than in one big bang. The other thing I would say probably is documentation. You can get into these processes and people actually find that the documents that they have are either not there or not well recorded, not easily retrievable. You can never start too early to actually bring that all into under some sort of level of control. Now, a lot of people have often done funding rounds, so they've obviously got data rooms from prior funding rounds, and the happiest situation we tend to find is when you go in and there's been a relatively recent funding round, the data room's been maintained. You can do a gap analysis of that data room against what an IPO data room would look like, which actually I've just done in the last month or so. And it's very easy then to extrapolate and broaden that out without too much friction within the business. I think the other thing is to think about, do you need any external resource to help you do it? I mean, there are plenty of project managers out there now who can come in and help, manage the business. Because one of the key things that we talk about is your advisors should allow you to keep running the business. You'll be going through a massive corporate event, probably the biggest one in the company's history, and how the best advisors will be the ones who take the strain off you and allow you to keep doing the day job, basically. That's a key point. Thinking about employees and how you're going to manage that is a key point, and you can't start that too early. I would, if I was in GC shoes 2 years out from IPO, starting to think about with you as the founder, what does our cap table look like amongst our employees? In an ideal situation, what would we want that to happen on IPO? Is there going to be a liquidity event? If there is going to be a liquidity event, how big is that liquidity event going to be, ideally? Obviously, you have to talk to your underwriting banks nearer the time about it. But how's it going to be? How much flexibility are we going to give? How far? Is that everybody, or is it just key employees? And what's the lockup going to look like? What's the quid pro quo going to look like? And the reason I say that is because I've been in a number of transactional situations where that comes up quite late and actually becomes very, very emotive. And again, it can really, really go to the core of the culture of the business if it's not handled correctly and communicated early.
That communication point becomes so critical. I mean, we've kind of talked a lot about culture, and I found that super interesting as a kind of angle here. But you get those communications wrong, or there's a perceived lack of transparency, or there's inadvertent leaking of information. It becomes I should imagine, like a huge problem for the culture.
It can do, it can do. And that sort of shades into the last point I made, which is around the systems and controls. Looking critically at how the business actually operates as a private company and thinking, well, how is that going to have to change? Which is related to the culture point, but how's that going to have to change and develop and be built out in the context of being a public company? Because it will need to. And again, working on that and thinking about that in an artful way is time well spent early on.
I think we have time for one last question. It wouldn't be 2025 without me asking you about AI. In the world we operate with at Juro, which is kind of very different, we see huge usage of generative AI for repetitive legal work, simple documents. Curious in the context of a listing where you have actually, from memory, extraordinarily complex documents like prospectuses, and you have very, very advanced due diligence to do. Are you seeing AI already have an impact there? Are you seeing real use cases?
To some extent, I would say, certainly in terms of the diligence side of things. So obviously, an IPO is going to involve an extensive due diligence exercise, not just by one law firm, by two law firms. So the company will have its own counsel, and then the underwriting banks will have their own separate counsel. Both will be having to trawl through the data and probably give what's called a 10b-5 disclosure letter, which is effectively a 1.5-page letter that just says the offering document is accurate and not misleading, materially misleading. So it's useful from that point of view of making diligence more effective, being honest with you. So we use it quite a lot for that. But it's also actually, we've just had an internal training meeting actually talking about it, where it's also being useful for just answering clients' questions a lot of the time. So empirical example came up this week was we have a company we're helping, a tech company, in fact, at the moment to list in London. And they said, well, we're not going to be completely compliant with the corporate governance, completely compliant with the corporate governance code. How common is that? And this particular set of facts that we've got, how often has that been the case in the last, what they said, 10, 15 years or something? And obviously, you and I have memories, and we can remember that we can give a sort of non-empirical answer and say, well, it's not that uncommon, people have done it. But actually, we have these AI tools now. We can just put it in and say, how often was there an observer from a major shareholder on the company's board? And suddenly you've got it. You've got all that at your fingertips, and you can help it. The AI can help you draft the disclosure as well, in 10 minutes, where in the past it probably would have taken 5 hours. So,
Or if it was me doing the first draft, double that.
I was going to say, I don't think the days when you and I were sort of sitting there doing verification and diligence are long gone. I think we were junior associates at a time, or trainees at a time. It was a very different world.
Exactly right. Yeah. So we've covered a lot of ground, Mark. I think my kind of key takeaways here, culture. There's actually something I've really learned about kind of listings and how that affects your choice, but also how that affects the process. I think it's been really interesting to hear just how much has actually changed over the last 4 years. And finally, the importance of being less British to make Britain great again, or whatever the phrase may be. I've really enjoyed the conversation. Thank you so much, Mark, for being on Brief Encounters.
Thank you very much for having me. I very much enjoyed it.